and welcome to Quilter Cheviot's Markets Uncut podcast, your weekly insight into the topics and trends that we've been exploring for you here at Quilter Cheviot. Remember, so you don't miss future episodes, be sure to hit the follow button on whichever streaming platform you're listening on, or by following hashtag QC Weekly Comment on LinkedIn. I'm your host, Chris Scott, investment manager based out of our Glasgow office, and this week I'm pleased to be joined by investment strategist Tim Armitage. Now, before we get started, I feel it's appropriate to remind our listeners that the podcast hosts are arranged well in advance of recording, so it's purely coincidental that we have a Scottish investment manager hosting following yet another Calcutta Cup victory at the weekend, but I promise to keep the gloating to a bare minimum. Tim, the only thing more volatile than Scottish rugby performances at the moment are investment markets. With equity markets in Asia and emerging markets showing recent strength, as well as the much discussed surge in gold price, coupled with wobbles in the US tech sector, do you believe that diversification in portfolios is now more important than ever?
Thanks, Chris. I'll move swiftly on from talking about rugby to one of my favourite subjects, actually, as an asset allocator, being diversification. I mean, my top level answer would be that I don't think it's necessarily more important now, but the current environment, it's a helpful reminder of why diversification is so important in investors' portfolios. We talk a lot about market regimes, and there are a number of different drivers that can move markets, and different drivers that have relative levels of importance over time. And we do have a number of quite strong themes in the markets at the moment, and you mentioned a few of them there. So the kind of disruption and changes that are ongoing from AI and technology changes, big changes in US foreign policy and economic policy that are driving large movements in asset prices, not least things like gold, and we'll touch on that in a moment. But one of the key drivers for correlation regimes, so different regimes where we might see either equities and bonds moving in the same direction or moving in opposite directions, is a constant battle between whether growth concerns or economic growth concerns or inflation concerns are really driving prices. And when we talk about sort of different market regimes, you can think about, I guess, two different axes to look upon. So one in terms of concentration. So are all assets moving with one key theme driving everything, or are there lots of different themes that are driving prices in different directions? And then broadly speaking, is the environment positive for risky assets, or is it negative, and is it more of a defensive risk off type environment? And at the moment, we would characterize where we are as something called local risk on. So that's generally supportive for risky assets. And we saw last year how well equities, broadly speaking, performed. Expectations for earnings growth still look pretty good. GDP, again, growth expectations are relatively positive, notwithstanding lots of risks here and there. But generally speaking, the environment for taking risk and being invested in riskier assets is quite positive. But at the same time, we're in what we would describe as being a local environment where there are a large number of drivers. It isn't one key theme that is driving everything, and therefore there are opportunities for stock selection. There are opportunities for tactical asset allocation, and it isn't an indiscriminate market that is driving everything either up or down. Just more on that in terms of different of those key drivers. Obviously, that tussle between growth and inflation is one of the key ones. AI disruption is a really key theme at the moment. And we're seeing that at the stock level. It's very hard to predict which underlying industries are going to be winners and losers from, and individual companies within those industries are going to be winners or losers from AI disruption. And it's very important also to note that the market tends to overreact to news coming out about these things, which adds to the volatility. Currency volatility is also another key driver, and Chris, you mentioned the dollar at the start. We know how much of an impact from an unhedged perspective, so holding equities or bonds but without hedging away the currency risk. We saw how much of an impact movements in the dollar had on those last year, and how varied that impact was in different geographies, with the euro and EM currencies benefiting from some weakness in the dollar. And then commodities is another key driver. We know how much of an impact oil prices can have on inflation and on other markets. And the gold price over the last year or so, and other precious metals and industrial metals as well, I should say, it's not just gold, really sort of driving different regimes.
That's great. Thanks, Tim. And you mentioned AI stocks there and the disruption caused in that sector of the market. And it's really been a key focal or discussion point with clients during meetings discussing these AI stocks and their recent strength. There is a bit of concern in the market that these are potentially becoming overinvested. Do you share that concern? And also, while we're discussing AI stocks, perhaps you could inform our listeners about the importance of capital expenditure or CapEx that's often referred to when we discuss these stocks, and why there's such a big focus in this area.
Sure thing. Yeah, there has been a lot of talk, and understandably so, about whether or not the large technology companies are overextended, whether or not we're in a bubble. My personal take is that I don't think we are yet. I think what we've seen over the last 3 months or so is actually following on from an extended period where those large, we often call them the Mag 7 or Magnificent 7, or hyperscalers, were very much the leaders of the US equity market and other markets that are kind of have a large proportion within technology. And I'll come back to that in a second. But over the last 3 months, we've seen somewhat of a rotation, with the rest of the market actually outperforming those larger companies. And I think this is actually an indication that we're not necessarily in a bubble. I think that that investors in general are holding those hyperscalers or those very large technology companies really to account, and we're starting to see more dispersion in their stock performance, and it's very much linked to whether or not their capital expenditure or CapEx plans are sustainable and realistic, and whether then their growth projections are realistic. So focusing specifically on the CapEx point, so there's an expected combined spending of around $650 billion on AI focused in infrastructure in 2026 from these 7 largest companies. So it's one of the largest investment cycles in technology history. Really, it's a significantly large number, and what we're seeing is that it's effectively a winner takes all battle between some of these companies. I think they're acknowledging that and we've seen this in technology over the last 20-30 years. It's sometimes it's not the first mover, but it may be the second or third mover. But those companies that are able to capitalize and take market share from others that end up doing particularly well. Now, why do they need so much CapEx? Well, the AI models that we're talking about, the training of those models, it's becoming increasingly capital and energy intensive, with the need for enormous data centers and very large energy supplies. So it really does need an awful lot of investment, and key to really whether or not that becomes or is sustainable is how long it takes for that capex to generate ROE, to generate return on equity. And it is an open question as to whether or not they are becoming overextended. Again, my take is that at the moment, no. A lot of that capex up until recently has come from cash flow. These are mostly companies that have generated a lot of revenue over recent years and have large sort of cash reserves that they've been able to spend on this. There has been more bond issuance more recently, and that's something that we'll keep a really close eye on. If bond issuance continues to increase, and therefore the leverage of these companies continues to increase, and that becomes perhaps a bit more of a systemic concern that they're becoming overextended. But for now, there are tangible revenue generating forward paths for this capex for the most part, and although there is some tempering of that enthusiasm by the market in general, I think it still holds relatively true.
Great, and I guess what feeds into that capex sort of end number is the earnings that these companies are reporting, and that's sort of fed into the share price strength of them, hasn't it? The constant great earnings numbers that they come out with each quarter, and I guess that's the real difference between now and the dot-com bubble. When back in the dot-com bubble, we had lots of companies with similar share price trajectories, but they weren't underpinned by such strong earnings, which is where these Magnificent Seven and other AI-enabled companies actually are underpinned by the earnings, which is supporting that share price valuation.
Yeah, that's absolutely right. That's one of the key differences, I think, and another being that the level of valuation is very different as well, from the dot-com bubble. You really did see those valuation metrics for unprofitable companies back in the dot-com era much higher than they are now. Yeah, and I think another point I just wanted to make that we over the last 2 weeks especially, we've seen signs of significant potential disruption to key industries. And there will be winners and losers within those industries depending on how far along the adoption curve those companies are. But there's no doubt that some of that lost revenue from underlying, I guess, old economy, I've heard it been talked about a lot, industries, is a lot of that revenue will show up in these larger tech companies as they take market share and they take different aspects of how we do things away from those other companies.
Great, thanks, Tim. And just lastly, we have some pretty important economic data coming out towards the end of this week in the US 2025 GDP figures, as well as some US inflationary data. Can you just tell us how important this will be to investors and what impact we might see in markets following the data release?
Yep, sure. So the US data has been interesting over the last week. Actually, we last week had the inflation numbers come out slightly softer than expected. So the US headline CPI number came in at 2.4%, and that was a little lower than market expectations of 2.5%. Sounds like a small difference, but actually when it's so keenly watched, it's very interesting to see that number come in lower than expectations and closer to the central bank's target of 2% inflation. And we also had a delayed because of some disturbances in the running of the US government and the funding of the US government a couple of weeks ago, but a delayed January jobs number that was stronger than expected. So before we even think about the upcoming GDP number, we've got slightly softer than expected inflation. We've got slightly stronger than expected job creation in the US market. Both of those are relatively supportive for the US economy. They certainly don't scream that that the US economy is slowing down significantly quickly or is in danger of dipping into a recession, and that's important. Going back to when I was talking about diversification before, and that sort of fight between growth and inflation, the fact that inflation is coming back to target, it's likely to be supportive for bonds actually, relative to equities, where we've seen yields come down and bond prices go up over the last few days in response to that. And I think that the less that we see higher inflation as a concern in the short to medium term, then the more supportive both monetary and fiscal policy can be for both bonds and for equities. So then looking forward to probably the largest data release we have this week, which will be the Q4 GDP number in the US. That's expected to be around 2.5% in real terms, and that's actually it will be a deceleration from the Q3 number, which was 4.4%. But a large part of that change and difference is the fact that we in Q4 had the government shut down over all of October and about half of November, and there are several impacts from the shutdown, but one of which is just economic activities from the government sector in the US. So that's a large explainer of why that number is a little bit lower. It should be a temporary impact, and our expectations for GDP in the US going forwards are around 2.3% for 2026, falling down to around a small fall to around 2% in 2027. But more globally, we see GDP growing at around 3% in real terms this year, and rising slightly to 3.1% the following year. So all in all, actually, again, as I was saying before, a relatively supportive environment for riskier assets and for equities. In terms of what we expect the Fed to do from here, because of the slightly more supportive data last week, the market has started to price in a slightly higher number of rate cuts in the US again. So around 60 basis points of cuts by the end of this year. So that's a little over two, what is generally a standard 25 basis point cut at any given meeting. But as with Europe and the UK as well, all of these larger Western economies look to be close to the end of their rate cutting cycle and close to what we would call the terminal rate. So from an economist's perspective, we will always think about where we are in the economic cycle, and the fact that we're coming or are likely to be coming to the end of the rate cutting cycle means that from that point, we may then start to see a reacceleration. So what often happens at the end of an economic cycle is you have a recession. There's every chance this time that we don't, and that we see what's often called a soft landing, and then after that fact, we see the lagged or the delayed positive impact from looser monetary policy, so interest rates coming down, and more supportive fiscal policy. And we've seen quite a lot of fiscal stimulus yet to come through in the US, as in Europe as well.
Well, that's great, Tim. Thank you for those insights, and to all of you for listening. That's all we have time for today, but we love to hear from our listeners, so please review the show now wherever you're listening and share it on your socials and tag us at Quilter Cheviot. To make sure you don't miss a future episode, tap the subscribe button. We'll be back next week, but in the meantime, head over to our website, www.quiltercheviot.com, where you can read the accompanying market overview, as well as subscribe to our weekly comment newsletter. Finally, if you have any questions you'd like to ask one of our experts for our next podcast, simply ask them via the weekly comments page on our website. And that's it for today, so thank you, Tim, for your time, and to all of you for listening. See you next time.
This podcast is marketing material, not investment advice or research material. Investments can go up as well as down, and past performance isn't a guide to the future.